Ever wondered how Bitcoin and crypto margin trading works in the USA? Is it even legal? Welcome to the fascinating world of cryptocurrency, where the rules are being written as we go along. Today, we're exploring the complex and intriguing concept of Bitcoin and crypto margin trading. This financial tactic allows traders to amplify their trading power, potentially raking in higher profits. However, it's not all sunshine and rainbows, as it brings along a higher risk factor, including the possibility of significant losses. So buckle up and get ready for an enlightening journey. Stay tuned as we delve deep into the world of Bitcoin and crypto margin trading. To start, it's crucial to understand what Bitcoin and crypto margin trading is. Picture this: you're in a poker game and you've got a strong hand. You're confident and you want to bet more than what's in your pot. That's where the house steps in, lending you the extra chips to increase your bet. This is margin trading in a nutshell, but instead of poker chips, we're dealing with Bitcoin and other cryptocurrencies. In the world of crypto trading, margin trading is a strategy that allows traders to borrow funds to increase their trading power. This borrowed money gives traders the opportunity to amplify their trades and potentially their profits. It's like supercharging your investment, leveraging your capital for greater returns. But just as it can turbocharge your profits, margin trading can also magnify your losses. If the value of your assets falls below the minimum margin requirement set by the exchange, you're hit with what's called a margin call. This is essentially a demand to either deposit more funds or sell off some of your assets to meet the minimum requirement. And here's where things can get a little dicey. If a margin call is not met, the exchange may liquidate your position. This means your assets are sold off, often at a significant loss. To mitigate these risks, savvy traders set stop-loss orders, use lower levels of leverage, and only trade with funds they can afford to lose. It's also important to remember that collateral is required when opening a leveraged position. Think of it as a security deposit. If the value of your assets declines and falls below the minimum margin requirement, another margin call may be issued. Liquidation occurs when your collateral can no longer cover your losses and the exchange closes your position and sells your assets. Now that we've grasped the concept, let's explore how it operates in the USA. The USA has a very regulated approach when it comes to Bitcoin and crypto margin trading. This is due to the high-risk nature of such trading activity that is characterized by potential for high returns, but also the possibility of significant losses. For the uninitiated, margin trading is a complex financial strategy where traders borrow funds to increase their trading power. While it may seem like an attractive option for those looking to maximize profits, it's crucial to remember that the stakes are high. If the value of the assets falls below the minimum margin requirement set by the exchange, it can lead to a margin call. Failing to meet a margin call may result in the exchange liquidating the trader's position, which can lead to substantial financial losses. To ensure fair play and protect traders, margin trading in the US is governed by strict regulations. Traders are required to operate through regulated exchanges that adhere to guidelines set by authorities such as the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA. These bodies ensure that exchanges provide clear guidance on margin requirements and maximum leverage limits. Moreover, exchanges offering margin trading need to have a FinCEN Money Service Business License. This license is issued by the Financial Crimes Enforcement Network, FinCEN, a bureau of the U.S. Department of the Treasury. It's a critical component in the regulation of margin trading in the U.S., as it helps to prevent financial crimes such as money laundering and fraud. In addition to these regulatory requirements, traders should also pay attention to the various costs associated with margin trading. These may include platform fees, liquidation fees, and network and transaction costs. In conclusion, while the US provides opportunities for margin trading, it does so within a tightly regulated framework. This is to ensure the protection of traders from excessive financial risk and to maintain the integrity of the financial markets. Regulation is a key aspect. But what about the practicalities involved in margin trading? Margin trading isn't just about understanding the regulations. It's also about knowing how to handle the practical aspects. Let's dive right in. Firstly, setting stop-loss orders is a crucial part of margin trading. These orders help you limit potential losses by automatically selling your assets if the market moves against your position. It's a safety net that can prevent catastrophic losses. Next, managing levels of leverage is another critical aspect. While high leverage can amplify your profits, it can also magnify your losses. So, it's wise to use lower levels of leverage, particularly if you're new to margin trading. Then we have margin calls and liquidation. A margin call is a warning that the value of your assets has fallen below the minimum margin requirement. If you don't meet this call by adding more funds, liquidation can occur. This is when the exchange closes your position and sells your assets. It's a harsh reality of margin trading, but one that underscores the importance of risk management. Lastly, don't overlook the various costs associated with margin trading. Platform fees, liquidation fees, and network and transaction costs can all eat into your profits. So ensure you've considered these expenses before jumping in. Remember, with great power comes great responsibility, and that is especially true for margin trading. So, is Bitcoin and crypto margin trading in the USA for you? We've delved into the concept, dissected the regulations, and examined the practical aspects. Let's round up what we've learned. Margin trading amplifies your trading power by borrowing funds, potentially leading to higher profits. Yet, it also exposes you to increased risks. Falling below the minimum margin requirement, you could face a margin call, and if not met, your position may be liquidated. To help mitigate these risks, consider setting stop-loss orders, using lower levels of leverage, and only trading with funds you can afford to lose. Remember, collateral is required for leveraged positions. Trading on US soil, you'll need to navigate a sea of strict regulations and comply with guidelines set by authorities like the CFTC and NFA. Only a handful of exchanges with a FinCEN money service business license can offer margin trading in the US. Consider the costs too, including platform fees, liquidation fees, and network and transaction costs. The world of Bitcoin and crypto margin trading in the USA is complex, but navigating it with the right knowledge can open up new opportunities.